Okay, well, Rajat Bhattacharya is now joining us. He's Senior Investment Strategist at Standard Chartered. Rajat, good to have you with us here. Thanks for your time. Is there anything on the horizon which could spoil the party, Rajat?
Morning. Glad to be here, Prashant. You mentioned in the stretched markets, right? So you talked about the US, India, and that is the issue here. But let's not forget what we've been through, right? The market and investors generally are rewarding growth. The three markets that stand out in the world today, US, Japan, and India. Now, think about it. That's basically three areas where the world sees growth. Funnily, I add Japan into it, but Japan is seeing actually turnaround in growth. And the last one I mentioned is India. Where else would you go today if you're looking for growth, right? So what happened since March, that turnaround since March, is that China's economy slowed down. After that post-pandemic bounce, it slowed down. And Europe started slowing. So obviously there is there's a premium to growth here, and that is what the Indian markets are reacting to. The US markets are reacting to. Now the key risk is the stretched investor positioning, and as you mentioned, this India market and the US markets are in the same place there. We look at fractals. It's a diversity indicator. It shows how diverse the views of investors are, and US and Indian markets are standing out there. So a bit of a consolidation here, but we can talk more about the long-term story. Structurally, as you know, we are very bullish on India.
Okay, structurally you're very bullish on India. I guess that's what our viewers want to hear, right, Rajat? Because this has been a fabulous rally. I mean, the Nifty is up 14% in just 3 months. The ferocity of this rally, does it surprise you? And do you think we've reached euphoric levels just yet? Or do you see lots more on the upside, particularly for a market like India?
Well, that's where the structural story comes through. And there's a good piece of research that actually our India research team has come up with. And maybe you'll get some time to look at that going forward. But what they're really saying, I'll give you the highlights there. They expect, our India research team on the ground expects India to be a $6 trillion economy. India is 3.5, as you know. It's expected to be a $6 trillion economy by 2030. And that's primarily driven by domestic growth, organic growth, housing consumption. This is what we've been talking about for a long, long time, but they've put some numbers to it. Another metric, India is going to be the third largest economy by 2030. Third one is India's per capita income is going to be almost doubling actually to $4,000 by then. Now, that means India is going to be a middle income country. Market, as we said, this looks at this growth and is willing to pay that premium. We know that Indian stocks are trading at a premium. US is trading at a premium. Now, what's driving this and going forward, is this sustainable? To your question, the key reason is macro and political stability. And by that I mean the fiscal policy, the external situation in India, and then taking it forward, the policy reforms that have happened, and investors are seeing the benefits of that record tax haven revenues being spent in infrastructure going forward, right? And they have already seen the roads, the airports, and that is going to continue. And a few other things that are standing out is the healthy financial sector that we see. There was a big reform that happened 5 to 10 years ago. And as a result, the financial sector is pretty healthy. Corporate leverage is at its lowest since 2008. And then you have the story of the digitalization, which is creating efficiency in the economy. And then you have the large population, the working population, which is scarce. I mean, if you look around the world, obviously the population headwind everywhere else. India stands in contrast. So all of this together makes for a good structural story.
All right, Rajat, we are feeling good. Listening to all that you had to say, per capita income doubles. We move to $6 trillion odd. Do you think that the Indian markets can further re-rate from here? Because now we're closer to the upper end of the long-term averages. You factored in close to around 1,000, 1,050 rupees of EPS in the coming years on the Nifty in the next 2 years. and we are at around 20 times. Do you think there is further scope for re-rating? Because as it is, we are at a big premium.
Yes, that is where the earnings growth story will come through, right? So India's been driven by the strong earnings growth, which is again scarcity has a scarcity value in the world. And if these reforms that I talk about, if this macro stability, the political stability pulls through, and we see that going through in the next 5 to 10 years, yeah, I mean there's scope for, I mean not re-rating, but the earnings picture will come through. Then Indian markets could trade back to reasonable levels. But when you contrast India with what is happening in the rest of the world, and you see that, a good example to that is what China is going through. Their long-term growth is slowing. China is probably going to settle down into a 3-4% growth economy. India is pretty much in that 6-7% bracket, right? So there is always that premium that will come through.
All right. Well, we leave it at that. Rajat, thanks a lot for joining in. Appreciate your thoughts here on CNBC TV18. So that's Standard Chartered saying that India is the place to be for an equity investor, especially a foreign investor, and that will continue in the times to come. Let's slip into a quick break. Lots of stocks to talk about, many numbers coming out today as well. All of that and more lined up on the other side. Stay with us.